auto loan. Okay, so if you have any questions, just raise your hand.
Awesome.
All right.
Good morning. If you have questions, can you see if they raise their hand or something? Okay, perfect. If y'all have questions, this is pretty interactive. I try to not be boring and just yap at you. But mortgage is one of those three pieces that you need in every transaction. We always need our realtor, we need our mortgage, and we need our title company. We've got a lot of other things that we need, but those three kind of set up that stool for success. And without that three-legged stool, it's two legs, and you're just going to fall over. So having the right mortgage partners and understanding mortgage is important as well. Because I get a lot of people who come to me and they're like, well, they have a 600 credit score. Why can't you give them a loan? Well, that's not the only piece to it. There's more than that. So it's important for you guys to understand the mortgage process and what it means and what we're looking for. So I'm going to go ahead and go to our next slide. There we go. So welcome to your comprehensive guide on the mortgage process. It's designed to help you provide the best service to your clients and close deals with confidence. One of the most important things that I tell people you can do is set your clients up for success on the mortgage side. Telling them that all they have to do is talk to the lender and everything's done doesn't set them up for success. They need to know it's a process. I have clients who actually come to me and say, okay, I gave you my pay stub, I'm done, right? We can go to closing. No, that's just not how it works. I mean, there's a whole process that we go through. And there's a lot of behind the scenes stuff that we do. So when I talk to clients, here's what I tell them. We're on a plane. We're taking a trip together. All of us, everybody's on the plane. You're on the plane. Your family's on the plane. Your realtor and I are your pilots. Our job is to get you to your destination, your new home, with as little turbulence as possible. We have people who are going to make sure you're safe. We have people who are going to throw baggage on the plane. We have people who are going to make sure that we have fuel in the plane. All of these people are part of our crew, and you may not see them. Have you ever taken a trip and you're looking out the window of the airplane and you're looking to see if your bags get on the plane? Yeah. Okay. We did that a couple weeks ago, and I told my husband, I was like, oh, there's your suitcase. Oh, there's mine. And he was like, we know they're going to get there, right? Yeah, but you got a lot of faith, and I don't. We got to make sure that everything gets to the right place at the right time, which is why we have to communicate too. And if you're telling your clients that all they have to do is provide that first piece of paper, just you're not setting them up with the expectation that it's a process. We're not going to have happy clients at the end, are we? And that's a big deal. That's why we do this class, so that you know and you can help your clients have the right expectation. So again, we're going to help you guide your clients to the home buying process. And our key components here include the pre-approval, which is what you want, right? That's where they should start before they start looking for a house. Underwriting and closing. Those are our big three pieces for the mortgage process, right? Oh, you're fine. I think I accidentally clicked on the Zoom thing and that messed me up. So let's talk about our types of mortgages, because people come into me and they're like, oh, well, I want just a mortgage. They have so many choices on a mortgage. There's so many pieces of it. So first thing they don't understand is the difference between fixed and adjustable. You can have fixed mortgages, adjustable mortgages on any kind of mortgage. So fixed, you know what that means, right? That means a fixed interest rate. The interest rate is going to stay the same through the entire life of the loan, right? Then we have adjustable rate mortgages. In a period where interest rates are going up, sometimes adjustable rate mortgages can be a good thing. Because if you think they're capping out, and we think they're going to drop in future years, that can be a good thing. Truth be told, we haven't seen adjustable rate mortgages in probably 10 years. Because they haven't been necessary. Rates have been low enough, and it's not been worth the risk to take an adjustable rate mortgage. Have any of y'all ever had a client who chose an adjustable rate mortgage? I can count on one hand in 20 years the number of people that have chosen an adjustable rate mortgage. It's just not common. Here's the other problem right now. A lot of adjustable rates are higher than fixed rates right now, because the market is trying to manage its risk. So then we talk about, a lot of people don't understand this. We have two ways of underwriting a file. We have automated, which is sending it through the automated underwriting system. You'll hear people say AUS. Now, if the AUS doesn't like it, then we can look at a manual underwrite. I'm doing a lot of manual underwrites right now. A lot of lenders don't like this. AUS, basically, we send it through that automated underwriting system. The automated underwriting system looks at everything it can see: credit, how long they live somewhere, what their rent is, and it'll come back with either, yeah, we like this loan, or we're referring it. Nobody wants to see a refer. If you get an automated approval, you can basically kind of ignore almost anything in that file, as long as the information you put in that automated system is correct. So if I say somebody's been on their job 10 years, they tell me they've been on their job 10 years, and the verification from their employer comes back that they've been there 10 days, that's not, it's kind of a garbage in, garbage out system. If you don't put the right information in, you're not going to get the right information back. So that's one reason I don't always encourage people to go to my website, because people don't put correct information in a lot of times. It's really common for me to ask somebody, okay, how much do you receive in disability? Oh, it's around $4,000, $3,200. That's a big difference. Or my favorite is when I say, well, how much do you make an hour? Oh, let's just round up to 20. 19 is a way different than 20 as far as income goes. So when I get somebody that applies to my website, I go through everything with them again. They're like, but I put that in. I know, but let's just talk about it for accuracy's sake. Because if it flips to that refer and we have to do a manual underwrite, okay, here's what I say about AUS. We have a box, and things can be sticking out of the box. We can have, like, things that are too big for the box, maybe things that are too small for the box. We can have, octopus tentacles hanging out of the box, as long as we can get that box okay. When you're talking about a manual underwrite, it's got to fit in the box perfectly. So that means the guidelines are a little stricter. And this is for all loans. So we haven't even talked about specific loans yet. But when you hear people ask, and some real estate agents who are pretty savvy over the last couple of years have asked me, is this a manual underwrite or do you have AUS approval? And if I tell them it's a manual underwrite, they don't like that, because they know that's a little riskier. But if we have a manual underwrite, we're going to put it through underwriting before they get under contract. We're not going to let people get under contract on manual underwrite unless we've already gone through underwriting. And that's a big key. So let's talk about your different kinds of loans. We've got VA. We all know about that one in our market, right? We've got FHA. We've got USDA, conventional. And we've got this other little category called non-QM. Non-QM is anything that's not going to be insured. So non-QM is like, you've heard of the DSCR for people who are buying investment property, bank statement programs. We used to call them stated income, no doc. We don't have those anymore. Here's what you need to know about non-QM. In a market where, actually, you know what? We'll cover that in a minute. But non-QM means it's not insured. So FHA, VA, USDA, Fannie Mae, Freddie Mac, those are all insured. So steps in the mortgage process. The first step is the pre-qualification, right? They call me, they either do their information online, or they call me and I take their information, over the phone, put it all in, pull credit. This is a key component of a pre-qualification. If the lender is not pulling credit, that's not a pre-qualification. As the market contracts, pulling credit is expensive. There are lenders who will start pulling just one bureau, or they'll just not pull credit. And we've seen this before. But you always want to make sure they're pulling credit. That's the pre-qualification. That's based on verbal information from the borrower, right? So once we get that information, a lot of times what we do is build a strategy. And this is something I do. Not all lenders do it, but I'll build a strategy. We may have somebody who says, I want a $200,000 house, but I can only afford a $1,200 payment. Those two don't go together right now, not with interest rates where they are. So we'll start putting together that strategy and explain to them, well, maybe you put a little less down. I had somebody the other day, they want to put 10% down. I showed him if he put 5% down and he bought his rate down, he's actually going to have a lower payment. So suddenly he's like, okay, hold on, that makes sense. So we're building that strategy to help make that home affordable to them.
Is that on the FHA?
That's on anyone.
And put the as far as put money down, like the VA too.
Oh yeah. Mhm. There's more bang for your buck buying your rate down with that same amount of money than putting it down on a house. And I can show you how that works. It's really incredible. When people see it, they get really excited because they feel like somebody's listening to them and actually helping them solve a problem instead of just saying, here's your mortgage. Mm-hmm. So then we're going to ask them, when I build that strategy, I'm going to ask them for documentation. I want to see your LES. I want to see that you're actually an E6 who gets paid for 13 years. I don't want to see that you're E5 promotable because there's a difference in pay. Mm-hmm. So we want to see that documentation so that we know what we're working with. After we get that documentation, that's when I recommend y'all go find a home. So when somebody's pre-qualified, you need to ask them, have you provided your lender with your documents yet? And if they say, no, but I want to go look at houses today, okay, let's get that information over to the lender so that you can make a stronger offer when you find the house that you want. This is where a lot of people fall apart, is between that provide documentation and find a home. Yes. I can't tell you how many times I have gotten a contract before I've even finished the pre-qualification. I know we don't want to lose a client, and we want them to get under contract, and we want them to get under contract with us. But it's really important because I've found things on somebody's LES or retirement statement or who knows that they forgot to tell me about. You know, we have things like retirement and alimony that gets paid out of retirement. There's a lot of things we can find on an LES that people don't realize. So find a home. At the same time they're finding a home, we're getting them in underwriting. We're going to go ahead and put that file in underwriting so we've got that fully underwritten loan. During that process, we're also going to get an appraisal because that's the big part, right? We're all scared about appraisals. We really shouldn't be. I'm not seeing a huge problem with appraisals right now. Are you guys?
Yeah. Not a problem, but some houses either they're overpriced, but it's not like too much overpriced. You know, it's like 5,000, 6,000, maybe 10,000 overpriced. But you know,
So
whatever it sounds like.
Good listing agents versus people who don't do a lot of listings. If I call and say, hey, the appraiser's coming in low, can you get me some comps? They're like, that's just what the seller wanted to list it at. Or they're like, here are the comps. You've got to be able to provide those comps. And I highly recommend if you're a listing agent or you're going to list houses, make sure you're going over that CMA with those borrowers, with the sellers. I did an open house with somebody this weekend. Every house in the neighborhood has sold or listed under $150 a square foot. This house is at $171.
Oh, no.
It's a huge difference. I mean, they were all going like 220. This one was at 250, 260. You're probably not going to get a price on that. Fresh paint does not add that much value to a home. And that's a big difference. But when I asked about the comps, they said, well, you know, this is just what we think it should sell for. In another neighborhood, it might. But you've got to be really careful about that. So after our appraisal comes in, we get our title work in, we've met all our conditions, then we get to go to closing, right? Yeah, that's the fun part. I like closing. I know. So let's talk about common mortgage terminology. Wrong direction. Yep.
Gotta go the other way, the other way, the other way.
And I'm playing with a new presentation format, so I don't like the way this is printing because you can't really read it. So I'm going to play with that too. So let's talk about common mortgage terminology. PITI. That's a big deal. I cannot tell you how many times I've gone online to look at a competitor's rates or stuff like that. I found one the other day. They said on a VA loan at X, it was like $300,000. The payment would be $1,249. I was like, there's absolutely no way. So I go to the fine print, and that says with a 40% down payment. Okay, we don't do 40% down on VA usually. And when people are looking at that payment, and it excludes taxes and insurance, which we know taxes and insurance have to be included. So PITI, principal and interest, that's paying back the loan. Then we've got taxes and insurance. Taxes are a big part of our payment here, aren't they? And we're about at a point based on the tax rates and all that you can use the 1% rule again on calculating payment. So if it's a $300,000 house, you can guess probably about $2,900 to $3,000 a month. That's just the reality of where we are now. The loan to value. This is a big deal because this is how much they have to put down. So loan to value, and it's based on the lesser of the sales price or the appraised value. So let's say that they're putting down 5% on a $200,000 loan, that's 10 grand, right? What if the house comes in at 190? They still have to put down 10% of the 190. Either the seller can come down on their sales price, or the buyer can choose to pay that extra 10,000. So if they're putting down 5% on 190, that's what, 9,500 now? And then they're also having to put down that extra 10 grand to keep that loan to value where it needs to be. Loan to value is also an important part of refinances. In Texas, you can't do a cash out refinance for more than 80%. So your loan to value is limited to 80% on a cash out refinance. That's coming into play a lot right now because people have so much credit card debt, but a lot of people have a lot of equity in their home. So we're using that equity to help them get out of some of that credit card debt. Even though interest rates are 7 to 8% right now, it's still cheaper than paying 24% on a credit card. And that's a hard statement for people. So if somebody's not putting down 20%, they're paying private mortgage insurance. Except on VA loan, right? Okay. Private mortgage insurance, depending on the loan type, is based on the credit score. On FHA loans, it's not, but FHA is typically going to be a little higher than conventional PMI. So there's definitely some factors to consider there, but that also factors into their payments. So my recommendation right now for people, for agents, let your loan officer calculate the payments. I have people who will send me 5 homes that they're looking at, a sales price, and I'll calculate payments for them. Because there's such a big disparity on taxes, depending on the home. There's also a lot of different factors that go into that payment. So mortgage insurance goes into that payment. And it's so much better if you let your loan officer calculate that. Yeah. All right. Down payments. One of my favorite questions lately. Can I roll my down payment into my loan? No, the down payment actually has to be made in cash. You can't finance it in any way or form. Most VA loans don't require a down payment. USDA loans don't require a down payment. But FHA and conventional require a down payment. Now, if we use down payment assistance, that can pay their down payments. But it's still a down payment required. One of the other things we can do to make sure that we get an approval, to get the AUS approval, a lot of times if they've got money in the bank, those are called reserves. That's the amount of money left in the bank after closing. It's not money I want my hands on, and they don't have to put it in a separate account for me. But sometimes I like to be able to see it. It improves the approval odds for someone. As we have more people who are higher in debt, as their debt to income ratio goes up, this will make a big difference. So a lot of times I'll tell people, remember, you have to have 2 months reserves in your bank account. Or you have to have 1 month reserve in your bank account. This is going to come into play more because people have higher debt to income ratios because they have a lot of credit card debt. APR. All I can tell you right here, this is not the interest rate. APR is supposed to be used as a shopping tool for people. So they're supposed to be able to compare APR from one bank to another to see if they're getting the best interest rate. I caution you not to let people do that. Because APR is kind of a misnomer in our business. Everybody's supposed to calculate APR the same way, but some companies calculate it a little differently. It's an interpretation thing. So here's what I tell you. When people are telling you their shopping interest rates, ask them about lender fees, points, and rates. People call me all the time and say, what's your APR? Well, that just depends. I've noticed a lot of people calling right now and just saying, what's your best interest rate? I can get you as low as you want to go. How much do you want to pay up front? And we have to look at whether that's a good thing. I was at an open house this weekend, and the people who had just bought the house across the street brought their friends over to look at the house. They were so excited. We think we should buy it. And I'm talking to the people who might buy a house, and we're talking about, you know, points and lender fees and all that other stuff. And the people who just bought the house across the street said, it doesn't matter what all that is. All that matters is you're getting the lowest interest rate. I was like, but if you spend $10,000 and it only saves you $10 a month, is that a good use of your money? And the guy that had just bought the house said, absolutely, you're saving $10 a month.
I
I was like, yeah, that doesn't work. Math don't math, does it? So it's important to ask questions like, how many points is that? Anybody seeing people post online? My client's just got a 6.75% interest rate.
Yeah, I think so.
I see it all the time. Okay, you're leaving out the most important pieces. Did they pay points? And what are the lender fees? If the lender charges a 1% for their lender fee, and then they're charging them 2%, that's 3%. It's 6.75. You need to know if that's really comparable.
And how long does it take you to get back that?
Well, and so part of what we talk about when we talk about building a strategy is I will put together a whole presentation for them showing how long it takes them to break even on that money. And that's a big thing, because if it takes 15 years to break even on that money and they're only there for 3, because our average military member is how many? 3 to 5 years? So if it's taking more than 3 years to break even on that money, I don't think it's a good use of money. Now, if they tell me that they plan on holding that house and renting it out when they leave, that may be a better use of money. Because now we're talking about cash flow for the future. So there's a lot that goes into that, and quoting interest rates is not your friend.
I know you're right.
As a realtor.
How much you say that the lender fee was? You said it was 2% or was that 1%?
It depends on the lender. Every lender has something different. Our lender fee on VA loans is 0. We waive it. Some lenders charge $1,500. Some lenders charge 1%. You really can't charge more than 1% without causing problems. But there are lenders who charge 1%. All right. So let's talk about our first. This happens to be my favorite loan type, and that is the VA loan. Every lender has their own credit score requirement for VA loans. We go down to 550 on VA loans. That doesn't mean they're approved, but we go down to 550. VA doesn't have a minimum credit score requirement. Lenders get to set their own. There are some lenders that require like a 660 and 680. It just depends on the lender. Fairly common is about 620. That's kind of the median. Is it? Okay. I think you get the best success at 620. Offering, you know, that's kind of, you're probably going to get it approved. Once you drop down below 580, it becomes much more difficult to get approved. VA has a VA funding fee, unless, do we know why we wouldn't have a VA funding fee? And in which case, they're receiving disability. Yeah. Nope, any percent. VA funding fee is waived as long as they receive any percent of disability. Here's another fun fact. If they close on their house and they have a pending claim with VA, and VA comes back and says, oh yeah, you were disabled and here's your disability percentage, VA will refund that funding fee.
And that's for all banks or just?
That's VA.
Okay.
Yep, that's VA. Because when we charge that VA funding fee, that gets charged on the loan, we have to remit that exact amount of money to VA. That's their insurance policy. VA came out this year and reduced the amount of the funding fee. For first time use, it's 2.15, and subsequent use is 3.3 now. It used to be 2.3 and 3.6. So it's reduced because they've had fewer claims. But the only way to avoid that VA funding fee is to have disability. They can mitigate it. They can drop it quite a bit by putting money down. So maybe they put down 10% and that'll drop the funding fee not quite a bit. If this is a subsequent use, so this is the second or third, fifth, 20th time they're using it, and they've got money to put down, it's a great way to reduce that funding fee quite a bit. If this is their first use, it doesn't make much difference.
So when you put money down, that brings down the VA funding fee.
Uh-huh.
And how much money would you need to like the
5%.
5%?
5%. So sometimes I'll have people tell me that they want to pay their VA funding fee in cash because they don't want to finance it in their loan. And usually I can show them, okay, it would be 3.3%. Why don't you just put down 5% and that'll drop it down like half. And so then that starts to make more sense to them and they like that. That's part of knowing how the loans work. And that's part of what I do, is trying to give people the most bang for their buck. Eligibility, it's super simple. If your lender is not pulling a certificate of eligibility on a veteran before they get out shopping, they're doing that veteran a disservice. I don't let anybody get out shopping until I have that certificate of eligibility in hand. That certificate of eligibility, 1, tells me if they're eligible. 2, tells me if they are receiving any disability, so I can waive the funding fee. It also tells me if they have any claims against their eligibility. So if they ever had a short sale, a foreclosure, a deed in lieu, anything that would impair their eligibility and might require them to do a down payment. Coincidentally, this is a statistic I ran up on the other day. 30% of veterans don't even know they're eligible.
Wow.
That's a huge number.
Yeah.
And that's simply because they aren't educated about it. They're not told that eligibility is fairly simple. A lot of agents are scared at VA because of the minimum property requirements. This is not hard. I mean, really and truly, the biggest problems we have are going to be peeling paint and rotten wood. Those are the biggest issues we see on VA loans. Peeling paint and rotten wood, it doesn't take a lot to mitigate that, to fix it. It's not super expensive to fix it. It's kind of a pain, but it's not super expensive. I think people really get worried about that because they think there's going to be thousands of dollars of repairs on a VA loan. It's really not that much more strict than a conventional loan or an FHA loan. We're worried about things like safety, security, so we want to make sure that the doors are on there and they have locks. If something exists in the home, it needs to function as intended. So if there's a dishwasher, it needs to function as intended. But VA doesn't even require that you have a stove or a refrigerator in there. They're not that strict. A lot of surviving spouses would qualify for a VA loan and don't even know it. It's a whole other group of people that qualifies for a VA loan. Let's talk about occupancy. You cannot buy a home using your VA loan and not intend to live in it. Yeah, you can buy a duplex, you can buy a triplex, you can buy up to a fourplex, or on a VA. I was like, what is the number there? You can buy up to a fourplex as long as you live in one unit. Yeah, sister, brother, uncle, aunt, father, mother, extended family cannot meet that requirement. Family, immediate family can. So if a veteran is, I've got one right now, he's in Vermont. He's doing, what's that called? Recruitment duty. He knows his next duty station is going to be here at Fort Cavazos. His wife and their child are going to be moving here. They're going to buy a fourplex. We can do that on a VA loan, even though he's not going to be living here. With his wife and kid. His wife and kid are. I have another one that called me the other day. His stepdaughter is going to live in it. She's 30 and she's got 2 children and she's going to live in it and he wants to buy it with his VA loan. That's not acceptable because she's not a dependent. It's got to be dependents or like spouse. And we do watch that pretty carefully because VA will send people out to the duplex, fourplex, multifamily, not so much single family, but multifamily. VA does an audit to make sure that we're actually doing it correctly. Good to know that. Any questions on VA? Any questions?
I have one. I have a situation where there's a widow of a service member who Well, he served honorably, did 4 or 8 years. He dies, but doesn't retire. He ended his term of service, went into private business, and then died. Would his surviving spouse be eligible for a VA loan?
It's going to depend on how it's coded. I would suggest we get a copy of it and we try and pull that certificate of eligibility.
You said you need his DD 214?
I would get the DD 2 and we can try and get the certificate of eligibility. The times that I find that they're not are if a divorce has been filed or if the surviving spouse remarries. So it's a pretty simple thing for a lender to pull it. And then once we get that, if it doesn't say what we want it to say, we can definitely go back to VA and ask them for an explanation.
Is that you good over there, Jose?
Yes. Yeah, I'm good.
Okay. So let's go on to FHA. FHA is kind of, I consider FHA to be VA's little brother for the people who aren't veterans. So we need something for affordability because we can't afford 20% down. So FHA requires a little bit of skin in the game. It requires a 3.5% down payment. We go down to 580 on FHA. Sorry, you're fine. We go down to 580 on FHA. Every lender kind of chooses. FHA, I think allows you to go down to 550 if you have a 10% down payment. We have not chosen to participate in the 550. FHA is really funny in the fact that they carry a neighborhood watch list. So if a lender has too many poorly performing loans, you end up on that list and you can lose your ability to do FHA. Wow. If you do those ones between 550 and 580, you end up on that list a lot faster. Wow. So we have chosen not